of what caused the Great Depression in the 30s?
Well, it was obviously the debt problem. To begin with, intergovernmental debt. What triggered it all was America, after World War I, insisted that its allies pay it for the arms that it had sold them before it joined the war. So England and France owed a huge war debt for the United States. They didn't have the money to pay, so they turned to Germany and said that Germany had to pay reparations. Well, Germany, meanwhile, had lost all of its coal fields, its steel fields, its assets were stripped. So it had to get the money to pay the Allies by borrowing from the United States. So until 1929, American investors would buy German municipal bonds and buy German stocks. The German central bank would take these dollars that it got for the bonds and would pay England and France reparations. England and France would pay the arms debts to the United States government that would then relend the money to Wall Street to buy more German bonds. And so this is a kind of circular flow. The problem is that all this required low interest rates in the United States so that people would borrow at a low interest here and buy the higher yielding German bonds. And in order to keep the interest rates low, just like Mr. Bernanke's doing now, the Federal Reserve supplied so much credit that it created a stock market boom that burst in 1929. That's what Mr. Bernanke's trying to do again. His solution to the Depression is to try to emulate the 1920s and create a stock market boom by just creating a lot of free credit or the bubble economy all over again, like he did when he was at the Federal Reserve. And the problem was that finally Germany couldn't pay. Europe couldn't pay. In 1931, the inter-allied debts and reparations stopped. But by that time, the American economy and other economies had run so deeply into debt that people had to use the income they had to pay their mortgages, to pay their personal loans. Companies had to pay loans, and they didn't have any money to buy goods and services if they were individuals. Or if they were companies, they had no money to invest in more factories and plant, and they wouldn't invest anyway because the individuals were all defaulting on their debt, so the economy shrank from debt deflation. Well, Mr. Bernanke wrote an article saying that nobody believes in debt deflation. That's wrong. You can ignore debt, ignore credit. All that matters is making prices of stocks and bonds and real estate high enough so the banks can make money. That's all he cares about. That's what he wrote. It's as if he were the marketing department of a commercial bank, not interested in the economy as a whole, or what I just said was economy number one. Not increasing production, not increasing wages, but just increasing bank profits. That's his concern, and it's what the Federal Reserve does. And that's why the last thing you want in the Federal Reserve is someone who is nominated by the banks who believes that the way to make the economy grow is to make the banks grow, because all he really makes grow is debt. And debt is the opposite of growth.
What is the dollar carry trade, and what are the dangers inherent in this carry trade?
The carry trade is when you borrow cheaply in one currency at a low interest rate and convert this money into another currency to lend out at higher rates. It began in Japan in 1990. After Japan's real estate bubble burst, the government, the Bank of Japan, tried to let the banks earn their way out of debt. So they did just what Bernanke is doing today. The Bank of Japan enabled banks to borrow at about 1%. So the banks would, in Japan, would borrow at maybe 0.5%, 1%. They'd lend it out 3 or 4% to foreign hedge funds and speculators, arbitrageurs they're called. So the speculators would borrow Japanese yen, would convert them into, say, euros and lend to Greece or lend to Iceland at 15%. So you could borrow cheaply in Japan, borrow and then lend to other countries, especially post-Soviet economies at 10 to 15%, and you could pocket the difference. Similarly today, Americans for the last few years, hedge funds and Wall Street has been borrowing from the banks at 1%, lending in euros at 5 or 6%, and pocketing the difference. And it's been not only the interest difference they get, but they've also got the appreciation, all this converting money out of dollars dollars into euros has pushed up the price of the euro against the dollar to about $1.60. As opposed to what it was at the beginning of the euro, 80 cents per dollar. So now that the European banks are going broke, now that the governments are enforcing a depression on their countries, now that the post-Soviet loans are going bad, all these speculators are repaying the American banks. They're selling their euro loans. They're saying, okay, let's get out of the euro bonds. They're dumping the euro bonds, and they're moving out of euros back into the dollar. Well, that's pushed the euro down to just about $1.35 right now. It's pushed the dollar's value way up because all this money pushing the dollar up is being used to repay all of the debt. So you're having a winding down of this huge superstructure of debt that was all built up largely to finance the real estate bubble over the last decade. And the repayment is pushing the dollar up and holding down interest rates here, enabling the U.S. to continue to try to inflate the stock market.
So has the low interest on the dollar helped the stock market?
It has, because companies can borrow at a low interest rate and buy other companies. The corporate raiders can borrow to buy. And hedge funds and speculators can borrow cheaply and buy stocks that are paying higher rate in dividends and pocket the difference. So low interest rates here basically inflate the price of assets. You can assume that any asset is worth the revenue it yields, the dividend or the rent or the profit divided by the interest rate, and the lower the interest rate, the higher the capitalization rates, the more that can be borrowed against it. And a house is worth what a bank will lend, and a stock or a company is worth what a bank will lend a corporate raider to take it over. And so low interest rates here spur a boom in real estate and stock market prices.
Now, can these low interest rates here in the United States go on forever?
No, only if foreign countries continue to recycle the balance of payments deficits here. But they now don't want to do that anymore because they don't see how the dollar can repay the money that it is already owed to foreign central banks. The U.S. government owes $4 trillion to foreign central banks, $2 trillion to China, $1 trillion to Japan, and $1 trillion to others. And yet the economy is running a chronic trade deficit because we've deindustrialized. It's running a rising military deficit as Mr. Obama steps up the military spending everywhere. He's now building up the military bases in South America for a war in South America, and that's driving South America into a block with Asia in response. And American money managers are taking the dollars they're getting and they're putting it into so-called emerging markets, namely anywhere other than the dollar.
Now, does that then mean that at some point the interest rates are going to have to rise here?
At some point they will, and as interest rates rise, stocks and bonds and real estate prices go back down. And the intention is that that's what essentially is going to wipe out most of the pension funds and the mutual funds and wipe out people's savings. If there's only so much wealth to go around, the banks have to wipe out the savings of most people in order for them to get what's left over, and that basically is the Obama economic plan.
Now, is this something similar that happened in the Depression in the 30s?
Yes, that's how it works.
I'm speaking with financial economist and historian Dr. Michael Hudson. Today's show, The New Junk Economics, From Democracy to Neoliberal Oligarchy. I'm Bonnie Faulkner. This is Guns and Butter. Now, you have written that, and I'm taking this a little out of context, Marxism pushed classical political economy to its logical conclusion in the late 19th century. What was political economy's logical conclusion?
The whole, from the physiocrats through Adam Smith to John Stuart Mill, classical economics was a reform program, and the idea was to bring prices in the marketplace down to the actual cost of production. That meant getting rid of unnecessary income, especially to the landlords, to the landed aristocracy for its rent, and finance. The idea was that the government would not tax labor, would not tax industry, but would tax agriculture and rural land, would tax basically the land value that nature created.